Good afternoon. My name's Mark Wollstonecroft. In this final session of the day, Megan Troxel and I are going to address some common accounting issues and challenges that we're asked about in the course of our day-to-day client service work. Our presentation here is titled A&A FAQs. Mike's was entitled Tax Potpourri. Mike has a more colorful name, right? But the subcontext for ours didn't make its way here, but Megan and I were talking about this as the Amazing Accounting and Assurance Amalgamation. So we've got a fancy title too, we just didn't put it in your slides. I like that title a little bit better because when you think about frequently asked questions, I think we got a lot of CPAs in the room today, and even if you work in the audit and assurance group like we do, the accounting and assurance group like we do, probably the most frequently asked questions that we get are tax questions anyway. So we're not going to focus on tax questions today. We're not going to talk about tax rates. We're not going to talk about what pets you might be able to deduct. We're not going to talk about tax policy or elections or what that means for tax policy. I'm glad that we have very capable folks like have presented earlier today to talk about those things. Secondly, when it comes to the amazing accounting and assurance amalgamation, I like that better than the frequently asked questions because Megan and I are each parents. We have families at home. And for those of you who don't know, my wife, Judy, and I have 5 kids at home, ranging from 17 months to 16 years old. So as you can imagine, we hear a lot of questions. And fortunately, we are not going to be addressing questions like, what's for dinner? Can you help me with my homework? Or where do babies come from? Instead, we're going to stick to the good stuff. Questions about accounting and assurance matters. So you're in for a good hour.
We're going to address common questions that we hear in discussion topics that we frequently find ourselves in the following 4 categories. First, specific challenges and opportunities amidst our current economic and business climate. Second and third are a bit more industry specific, and they may impact you regardless of whether you find yourself in the particular world of employee benefit plans and not-for-profits on a full-time devoted basis. And then lastly, we'll cover some best practices in record retention.
As we begin to look at some of the accounting and issues and challenges resulting from current economic and business climate, workforce availability is certainly a significant factor. We've heard about it already today a little bit. I'm confident that everyone in this room has experienced the effects of limited workforce availability in our personal lives, in our professional lives, in our businesses, or both. Really, limited workforce leads to prioritization. I noticed this clearly, I think we keep getting ahead on the slides. I noticed this clearly this past summer. My family took a couple of road trips this past summer. We drove to Birmingham, Alabama in June to visit my in-laws, and we drove to Charleston, South Carolina in August for vacation. These were both roughly 10-hour trips, so we were looking to keep our pit stops short, right? As we looked for places to eat along the way, it became, I didn't expect this. Around here, it seemed like restaurants were generally open. Things were generally open at the time we left to go down on these trips. But what we found was that as we looked for a bite to eat, the fast food restaurants had clearly prioritized the drive-through lanes over the restaurants themselves. So as a result, it was clear from the long drive-through lines, which spilled out onto the main roads, and was also evident from the lack of public dining rooms and restrooms, that they had prioritized the drive-through lines. So I returned from these trips with a little bit of a bitter taste in my mouth with respect to these workforce changes. I'm sure you've all had a little bit of this yourself. I mean, number one, my car was a disaster because I had 7 people eating in it, meals on the way down and on the way back from vacation. And then secondly, in one of these situations where the drive-through line had spilled out into the road, I swerved to miss the Wendy's drive-through line and got into the car next to me a little bit. Fortunately, no one was hurt, but that accident was more than 4 months ago, and my vehicle still has the damage to prove it, and that's because of some of the supply chain issues that we've talked about earlier today too. So we've all experienced them. We've experienced the workforce shortages. We've experienced the supply chain issues. And when we talk about prioritization, we talk about the prioritization of the drive-through lanes. Prioritization is happening all around us. It leads to changes in all of our businesses. And as accountants, it's really important for us to be thinking about the impact of those changes. You know, I expect that if you work in the fast food restaurant, I expect that all the fast food restaurant metrics have changed as they prioritize the drive-through lanes. I expect that they were generally more productive, and they probably spent less money on certain supplies that come with having a public dining room open. I expect that the nearby gas stations, when you couldn't go into the restaurants, I noticed that the lines for the restrooms at the nearby gas stations were very long. So I expect that their sales were probably up as people were stopping in to utilize their facilities. We've all heard about the insurance companies and the impact that the pandemic had on the level of claims, whether they be medical claims or whether they be car claims. So there's definitely changes, and we need to be thinking about what the impact of those changes are on our businesses as we seek to do the right accounting. Some of the operational changes will get picked up pretty seamlessly in the accounting process. So if you simply have an increase in payroll, or you simply have an increase in costs where you're purchasing from vendors, a lot of that stuff's going to flow pretty uneventfully through the accounting process. But there's a lot of things that may require some more critical thought as you're closing out your year. For example, you know, to the extent that you have, use standard costing. You know, hopefully you've been adjusting your standard costing along the way, because your actual costs today are probably different than your standard costs, and that could be impacting your accounting for sure. You may have changes to production costs or production efficiency because you've prioritized one product over another, and that could be impacting your labor rates, your overhead rates. Certainly, if you have inventories and you had changes that impacted the way you were doing business, you probably need to be looking at your costing systems. We've definitely had clients that had significant surcharges during the period, significant shipping costs during the periods, and those can also be impacting the carrying values of your inventories. On the reserves and the accrual side, there's changes to the way that customers are paying you. There's changes to the way that you're paying your vendors. There's changes to the way people are taking their PTO. So your PTO accrual may need a look. There's a lot of different things that might need a look as a result of some of the changes that have happened as a result of workforce changes and as a result of supply chain changes. So those are some of the things that might need some attention in conjunction with your year-end closing process as you prepare for the year-end audit. Also, something that Megan and I have talked about a little bit last year is just your internal controls. The workforce changes can impact your internal controls. That can be because it may be because of a shrink in your accounting department. It may be a function of changes elsewhere in your business, but it's important to be monitoring the design and the occurrence of the internal controls so that in case you had a control that was in place and effective, now you're down a person, your controls might be less effective than they were beforehand. So as accountants, it's important for us to be paying attention to how many folks do we have doing it, what are the controls, and what are the results of the staffing changes. So certainly a lot goes into thinking about the workforce changes and the impact that they may be having on your accounting process.
So while Mark covered workforce changes on a broader scale, I'll share with you some of the specific impacts that we're seeing in public accounting. First, this is not a new concept at all, but we continue to recognize the importance of attracting and retaining talented professionals. Discussions have been well underway on two topics that we're going to cover more in depth right now. The pipeline of accounting candidates and the new CPA exam structure. Additionally, we continue to look for ways to automate routine processes and enhance our efficiency. We'll touch briefly on some of the technology tools that you may interact with if you are a client of the firm. So let's start with the pipeline of accounting candidates. As the face of higher education is evolving, the Center for Audit Quality commissioned an extensive research project to understand the student mindset and perceptions about the accounting profession. Today's college student population is more representative of our communities and societies than it has ever been before, with more than 50% of today's undergraduate population comprised of students of color, compared to only 30% in 1996. It's also worth noting that 56% of undergraduates are now first-generation college students. So you would think that this more diverse student population would translate to that same diverse pool of candidates in the accounting workforce. Yet that is not the case. The purpose of this body of research then is to understand how students make career decisions. What are the important touch points throughout their educational path? Who or what influences these students in making important decisions about their futures? What are students' biggest motivators and priorities in making a career choice? And getting more specific into the accounting profession, how do students understand and think about a potential career in accounting? Are there any notable distinctions in perceptions based on students' age, race or ethnicity, or among the first-generation college students I mentioned? And most importantly, where do we see the greatest potential to increase the pipeline of diverse talent coming into the profession? As we try to understand the motivations of today's high school and college students, the data shows us that the top priority amongst all student demographics is the importance of having an interest in and enjoying their work. The current generation of students is particularly focused on fulfillment, stability, and culture when it comes to their future career paths. So what do we mean when we talk about fulfillment? We're talking about enjoying the work and holding interest in the work. Growth and learning opportunities. Purpose and impact are extremely big factors in the fulfillment category. Today's students also want to see dynamic work with a variety of tasks assigned to them. Students also want to see work that they have a particular aptitude for. They want to find a sense of achievement, and they want to have work that is challenging. When it comes to stability, it is mainly sought in income and benefits, the educational background that is needed, and job availability, of course. Notably, though, this is a shorter list than the other two categories that we're taking a look at. And finally, culture. This is defined by the specific corporate culture, the work-life balance that people can expect to have. People are very interested in workplace flexibility, the physical work location, of an office and potential travel opportunities. So I decided to take an informal poll of a group of middle school-aged kids I coach for Odyssey of the Mind, and I also layered in Mark's kids' career aspirations to see how we compared to the word cluster that was part of this research project. Admittedly, it's a little bit of a younger age group, but we got responses ranging from computer programmer to photographer to mom. And then their responses were also aligned with some of the bigger words that you see here on this slide. We've got a teacher, a doctor, and lots of engineers and lawyers. All of us by now know the acronym STEM: science, technology, engineering, and mathematics. And that's due to more than 2 decades of national advocacy to recruit students into these careers. The research in this accounting-specific project actually shows that there are a wide range of students who are open to accounting at the outset of their educational career, but the interest tends to drop off steeply when looking at the actual pursuit of an accounting degree. So, who might be the influencers on how college students decide to pursue an accounting career? Here's the hint. It's probably every single one of us in this room. So let me say that again. Each and every single one of us has the opportunity to have a positive influence on the accounting profession. The data shows now that the impact of high school guidance counselors and faculty advisors is very hit or miss. The research does show that mentors and work experiences can have the most influence because they offer direct exposure to the field, providing firsthand experience. Not surprisingly, 3 out of 4 accounting majors today know an accountant personally, confirming the highly influential role of personal connections. If you follow our social media outlets at GYF, you'll frequently see that we're in the classrooms at colleges and universities all across our region. Sure, we do lots of direct recruiting there, but we also recognize that choosing a career in accounting is more of a journey than a one-time decision. So we want to contribute throughout the process of students making this important decision. So this gives us a nice segue into our next topic of the CPA exam. By show of hands, how many CPAs do we have in the room? All right, now keep your hand up if you passed the exam under the paper pencil exam. Still have lots. I get to keep mine half up. I passed my first 2 parts under the paper pencil exam and then passed the other 2 under the computerized exam. And that was the last major change that the CPA exam underwent. So I'm going to turn it over to Mark and he'll go over some more details on that.
Thanks, Megan. This next slide gives a good picture of what's happening with the scheduled change in the CPA exam. The CPA exam is scheduled to change beginning in January of 2024. It's going to move to a more core plus discipline model. They call it a core plus discipline model. So there are 3 core sections that will be required: a financial accounting section, an auditing section, and a tax section, or the core sections, and that's relatively consistent with what exists now. And then instead of there being the current BEC section, students will now choose from their 4th section. They'll choose from 3 different options. The first option is business analysis and reporting. That area will test skills related to assurance and advisory services, financial statement analysis and reporting, technical accounting, and financial and operations management. Next, you'll be able to select the tax compliance and planning section. Obviously, that's going to test skills related to individual tax compliance and planning. It's also going to address personal financial planning, and it will address entity tax compliance and planning as well. And then finally, there's an option for the information systems and controls that'll focus on business processes, information systems, information security and governance, and IT audits. The next slide shows a little bit of the information organized in a little bit different way. You can see, here we go. You can see there that the current exam includes the audit, FAR, Reg, and BEC sections there on the left column, and then the new 2024 CPA exam evolution essentially continues to include the audit, FAR, and regulation systems, and shows the 3 different options you'll have instead of the BEC exam that currently exists. So it's good. So I think there's some good changes there. Obviously, there's different paths in public accounting, and Megan and I are talking mostly about the accounting and assurance side of things today, which would probably fall best under the business analysis and reporting section. We had some folks from our IT group present earlier, that probably would fall better under the information systems and controls section. And then obviously Don, Mike, and Ryan presented to us on tax matters, and I imagine they would have drifted towards the tax compliance and planning section. So I think it's some good changes that allow you to focus on a particular discipline. Megan mentioned that we would talk a little bit about automation and efficiency tools that you might interact with in conjunction with your work with GYF. First, and we have 3 examples here. First, I'll touch on SharePoint. SharePoint is just a traditional secure portal for the exchange of information. Next, we have Inflow. Inflow is a tool that we began to use about a year ago. We currently use the Collaborate module within Inflow. It's a modern web-based tool. We use Inflow really to request information from our clients and to receive information from our clients. We use it on most of our accounting and assurance engagements at this point, most of our audits, reviews, and compilations, and we also use it on some of our tax engagements as well. One of the nice things about Inflow, it kind of takes the place of our old client participation schedule, which we would provide to the accounting team, but there was really not a way to monitor what had been provided and what had been received. So this provides good clarity both to our team and to all the folks on your team relative to what the status of the information that has been provided is. So we've received really a lot of good feedback on this tool, plan to use it again in the coming year. And we're also investigating some of the other modules that are available under Inflow. They have some tools that look pretty promising relative to some of the analytics that are required both in our audit and our review engagements. So we'll be looking at those. We'll be looking at those a little bit further as well. And then lastly, under the heading of IT tools, we talk about MindBridge. MindBridge is really a risk assessment automation tool. It takes a deep dive into the general ledger data, and it'll score transactions based on a variety of risk assessment algorithms. So it takes a deep dive into the GL, it runs the GL through different algorithms, and then tells you essentially what the most risky transactions in a general ledger might be, and maybe where you want to focus some attention as an auditor or as someone trying to take a look at the detailed accounting records. This tool, as you can imagine, when you're taking a deep dive into the general ledger, does require a little bit of upfront mapping, in the setup of using this tool, but it can provide, if it's worth that initial investment, it can really provide some really good information on the back end relative to where risky transactions are. So MindBridge is not part of our standard audit approach right now, but it is a tool that we have available for instances where it does make sense, particularly in a fraud-oriented engagement or an engagement where, you know, there are concerns about the accounting records. So if you're interested in any of those tools, we're happy to talk about them. I think MindBridge could be a very interesting tool in some particular circumstances if you had a particular risk profile. So again, those are some automation and efficiency tools that we currently have available to us, and we continue to look at those really throughout the year as the possible tools that might make sense for us to use going forward. Since it's an amalgamation, we're jumping around a little bit. You know, when we think about the topic and frequently asked questions and what's going on in our group, certainly throughout the last couple of years, there have been a ton of merger and acquisition opportunities. We have a very active client base in terms of looking to buy businesses and sell businesses. On the A&A side, we're active with quality or earnings engagements. We're also involved with purchase accounting when our clients buy businesses. I have a client that's has closed 2 deals in the last 2 months and plans to close 2 more before the end of the year. So they're certainly keeping us busy from a purchase accounting perspective, and that's fun to work on those sorts of deals. And then I think, as Dawn mentioned a little bit earlier, that the tax group certainly stays very active in this space too, both helping with tax diligence and helping with deal structures. So there continue to be a lot of M&A opportunities, and it's a space that we know well and are happy to help with. Next, we're going to jump to the topic of going concern, and this is a topic that's been around for a long time, but we wanted to spend a little bit of time on it this afternoon, principally because you may have noticed the language come up in your audit report last year. And so when the term going concern was used in the audit report last year, even in unmodified opinions, Megan and I started to get more questions on the topic. So the continuation of an entity as a going concern has been and continues to be the presumed basis of financial reporting. And that's unless and until liquidation becomes imminent. So in almost all cases, we're reporting on the going concern basis of accounting. For many years, the technical literature around going concern was in the AI CPA audit literature, which was a strange place for it, considering that it's reporting oriented, not necessarily audit oriented. During 2014, the FASB essentially moved that, didn't move it, but also included going concern in management's responsibility. So they defined management's responsibility for going concern, which clarified that it's not just an audit matter, but it's also a matter for management. And then, as I mentioned, beginning last year, the standard language in the audit report includes a comment both regarding management's responsibility for going concern and the auditor's responsibility for going concern. So we wanted to talk a little bit about going concern, and we have a few slides on it here this afternoon. So, you know, before liquidation is deemed to be imminent, an entity may still have uncertainties about its ability to continue as a going concern. It's not always clear cut whether that's going to be possible or not. And when we talk about going concern, we're really talking about a time frame that spans essentially 1 year from the date the financial statements are available to be issued. So when there are uncertainties about an entity's ability to continue as a going concern, the entity should continue to prepare its financial statements using the going concern basis of accounting, but there may be additional disclosure information that's necessary in the report, and we'll talk a little bit about that in the coming slides. So the literature regarding going concern is really in FASB's Accounting Standard Codification 205-40. It provides guidance on how management should perform a going concern assessment and when going concern or disclosures are required under U.S. GAAP. And it's basically a two-step process. The first step is to evaluate conditions and events considered in the aggregate that raise substantial doubt about the entity's ability to continue as a going concern within 1 year after the date the financial statements are available to be issued. So step one should take into consideration the actual conditions as of the year-end date of your financial statements. It should not take into consideration any plans that management may have to mitigate any concerns. So the first step is really around what exists now. So step one, consider the relevant conditions and events known and reasonably knowable at the date the financial statements are issued. That'll include the entity's current financial condition, including its liquidity sources. It'll consider the entity's conditional and unconditional obligations. It'll consider the funds necessary to maintain the entity's operations, considering its current financial conditions, its current obligations, and other expected cash flows. And you should also consider other conditions and events that may adversely affect the entity's ability to meet its obligations as they become due. So what are some examples of adverse conditions and events that may raise substantial doubt about an entity's ability to continue as a going concern? That could be negative financial trends. Often when we're reviewing a set of financial statements, we're looking at, are there recurring operating losses in the entity? Are there working capital deficiencies? Are there negative cash flows from operating activities, especially year over year? And are there other adverse key financial ratios? So there may be negative financial trends. Other adverse conditions or events could include indications of possible financial difficulties. Some of those might include defaults on loan agreements, a need to restructure debt to avoid default, or needs to seek sources of financing, or maybe to dispose of substantial assets in order to raise funds to continue. There may be internal matters or external matters. Some of the internal matters may include work stoppages or labor difficulties, substantial dependence on the success of a particular project, or the need to significantly revise operations. Some external matters could be legal proceedings, legislation, or similar items that might jeopardize the entity's ability to operate. Losses of a principal customer or supplier, or an uninsured or underinsured catastrophe. So when we're considering going concern, we want to think about these items and whether these items raise substantial doubt. So after we look at that, if there are no conditions or events considered in the aggregate that raise substantial doubt, then essentially we're done. The entity's not required to include any disclosures on the topic, and the current period financial statement does not need to conduct any further analysis. So essentially, a good practice is, especially if there are some items that jump out, is to have a memorandum that indicates that you've considered going concern and what factors you considered in evaluating whether or not there was substantial doubt considered in the aggregate. If there are conditions, then the entity has to evaluate whether then the entity switches gears and says, okay, we know there are conditions that raise substantial doubt. Or do we have plans that help to mitigate that doubt? And that's where step 2 comes in, and Megan's going to cover step 2.
So it's a 2-step process, but I don't know how many slides we have devoted to this. It's a rather complex 2-step process. So if there are conditions that raise substantial doubt after going through that step 1 process, we're going to take some further steps here that I'll walk us through. So then we need to evaluate whether plans that are in place that are intended to mitigate the conditions identified in step 1, when they're implemented, whether they will be able to alleviate that substantial doubt. So once we evaluate and we conclude whether or not those plans alleviate the substantial doubt, we'll need to look at whether it is probable that management's plans will be effectively implemented within 1 year after the date the financial statements are issued. It's important to remember that that's the time frame that we're looking at here. That's the definition of the time period that we're looking out at, that management is and that the auditors are agreeing with. We also need to look at whether it's probable that management's plans, when implemented, will in fact mitigate the relevant conditions or events that originally raised the substantial doubt. So in addition to the time frame that you're looking at, you're looking at the effectiveness of what management's plans, how they will play out and whether or not they will in fact alleviate that. So generally, to be considered as probable of being effectively implemented, management must have also approved the plan before the financial statements will be available to be issued. So management should consider the expected magnitude and timing of the mitigating effect of its plans in relation to obviously the magnitude and timing of the original conditions that raised that substantial doubt and that brought about the concern. So Mark walked us through some of the examples that might have brought us into the situation where we needed to move to this step 2. Some of the examples that may allow us to look at management's plans to alleviate that doubt would be to dispose of an asset or business, or in some cases it would be a particular channel or product that is not performing well within an organization, possibly to borrow money or restructure debt so that there is additional cash flow to be able to meet the demands that are coming within the next year. Another plan that could be used would be to reduce or delay expenditures. And one other option might be to increase ownership equity. So tying this back to the previous information that we looked at, our audit procedures then, once management has come up with the plan as to how this would be alleviated, our audit procedures are going to be to assess whether we agree with management's plans and whether we think that they're achievable and will in fact be able to alleviate that substantial doubt. So as we move to the next slide, we do have a chart here of what the disclosures are going to look like when you went through this 2-step process. So in the second step, our first option would be on the left-hand side of the chart here. If substantial doubt was originally raised and management has plans in place that will be addressing that, there will be required disclosures for those original principal conditions or events that raised the doubt, management's evaluation of the significance of those conditions and events, and then what those plans are that are in place that alleviated the substantial doubt. On the second side, on the right-hand side of the chart, you're going to see some additional disclosures when that doubt is not alleviated. So you still have the exact same 2 disclosures on the first 2 rows there. And then management's plans that are intended to mitigate that substantial doubt, but there still remains some doubt as to whether or not those will actually be able to be achieved. And then further, a statement that there truly is substantial doubt about the entity's ability to continue as a going concern. So what is shown on the slide here is the disclosures that will be in the actual financial statements. But then on the auditor's side of things, we will need to go through management's assessment and see that we agree with what management has in place here. So the other impact that you could see in the report is that there may be some clarifications there. So if the financial statements, if management has landed on the left-hand side of the chart, but the auditors do not agree with that fact, then that would lead to an adverse opinion by the auditor. If management has landed on the right-hand side of the chart and they have all of the disclosures related to what the doubt is, what the plans are, and that there is substantial doubt, the auditors would go through that assessment, see that they agree with that, and then there still would be some disclosure in the report that there would be a specific section about that entity's ability to continue as a going concern. It would draw attention to the disclosure in the financial statement and state that the auditor's opinion would not be modified with respect to that particular matter.
All right, continuing with our amalgamation, we're going to turn to a couple questions on employee benefit plans. I actually got a question along these lines just yesterday. The question is, does our retirement plan need to be audited? We'll think about this in terms of a 401k plan. Does our 401k plan need to be audited? And the general rule is that ERISA generally requires plans with 100 or more participants at the beginning of the plan year to have an audit of the financial statements. I think it's important to recognize here what does participant mean. I know I was the situation that we were looking at yesterday. There had been a relatively new plan. There were 150 people eligible to be in the plan, but only 20 people had contributed to the plan. So there was one line of thinking that an audit would not be needed because there were only 20 people that had balances. But unfortunately, when you look at the DOL guidance, the participant account includes not only folks that have balances, but also everybody that's eligible to participate. So if you had 150 employees and everybody was eligible and only 20 people actually participated, you would still be required to have a plan audit. There is what's referred to as the 80-120 rule, and that softens that general rule just a little bit. Really, the audit requirement is driven by whether a plan files a Form 5500 short form and is thereby considered to be a small plan, or if they are required to submit a full Form 5500, in which case they're considered to be a large plan. So if you think about it, if that 100 participant rule were applied, without exceptions, plans that were in that, one year they had 80 or 90 participants, the next year they had 105 participants, the next year they had 95 participants, they'd be bouncing back and forth between having to have to file a long Form 5500 or short Form 5500, and they'd be bouncing back and forth between whether or not they required an audit. So this rule is essentially intended to mitigate that need to switch every year. And so practically that means that if you filed as a small plan last year, let's say based on you having less than 100 participants, you could, as long as you have less than 120 participants this year, you could file as a small plan again, even though you had more than 100 participants, because last year you filed as a small plan. And so this is a way that at times you may not have to have an audit even though you have more than 100 participants. This really only lasts 1 year though. So if you had 90 participants in year 1, you filed as a small plan. You had 105 participants in year 2, you filed as a small plan again because you're allowed to based on last year. Go to year 3, let's say you have 110, you're now going to be required to file as a large plan. And that's because that 1 year exception only lasts for 1 year. So what I would tell you is these rules are pretty granular. If you're in that 80 to 120 band of people who have balances and people who are eligible, give Megan or I a call. We'll happily look at that together with you to determine whether or not your plan's required to have an audit. From time to time, we also hear questions about health and welfare plans. Whether or not those plans are required to be audited depends on whether they're fully insured and or whether they're funded. Fully insured plans generally do not require an audit, and funded plans generally do require an audit. Again, if you're not sure, we're happy to take a look at that for you and help you to determine whether or not your health and welfare plan requires an audit. And then next, and lastly, under the employee benefit plan section, how can we correct plan errors? We just got finished with employee benefit plan season. All of to the extent you have a December 31st year end, the extended due date for the Form 5500s this year was October 17th. And the fall always ends up being a busy time getting those plan audits and those 5500s done. We do from time to time come across errors that occurred in the course of operating retirement plans. Actually, it tends to be the TPAs when they're performing testing that identify some of the errors, or the management team that identifies some of the errors. But we wanted to talk a little bit about some of the avenues for correcting plan errors. Some of the errors that can occur, you can have delinquent employee elective deferrals. There can be errors in the calculation of deferrals, and there can be errors with respect to employer contributions. Some of the avenues that the DOL and the IRS have to correct plan errors include the DOL's Voluntary Fiduciary Correction Program, and then the IRS has an employee plans compliance resolution system, and under that compliance resolution, they have 2 programs, a self-correction program and a voluntary correction program. So touching first on the DOL's Voluntary Fiduciary Correction Program, the Department of Labor requires that an employer deposit deferrals to the trust as soon as the employer can. So if you withhold money from an employee for a 401k plan, you're required to deposit that money into the 401k plan as soon as possible. There is a safe harbor rule for small plans with less than 100 participants. It's a 7-day safe harbor rule. There is no safe harbor rule if you have more than 100 participants. You really need to get it in there as soon as administratively possible. We do run across, a lot of the TPAs are doing testing around how quickly money is getting into the plans. They're identifying issues where money is not deposited as quickly as it ought to be. And if that happens to you, you can go through this voluntary fiduciary correction program in order to mediate that. It's really pretty straightforward. There's even a safe harbor calculator to say, hey, here's how many days it was from the time we collected the money to when we put it into the plan, and then there's a calculation with respect to what should have been earned on that money between when it went in and when it should have went in. So just want to let people know that there is a voluntary fiduciary correction program under the IRS, and then this IRS employee plans compliance resolution system deals with some other matters. There's a self-correction program. The good news is that a lot of errors can be corrected under this self-correction program without any IRS involvement or fees. Some of the operational failures that can be addressed under this program include failure to follow the terms of the plan, excluding eligible participants, not making contributions promised under the plan terms, and loan failures. And they basically divide errors into insignificant operational failures and significant operational failures. But either way, even if you have what's deemed to be a significant operation failure, you can generally correct those as long as you do so before the third plan year after the failure occurred. So you have some time. If you found out either in your testing process or in your audit process that something didn't go as planned, you have some time to correct, even if it's deemed to be a significant operational failure. Some of the factors that go into determining whether it's significant or not include the number of failures that happened in the same period, the percentage of the plan assets and the contributions involved, the number of years for which the error occurred, the percentage of participants impacted, the reason for the failure, and how soon after the error was corrected after it was discovered. Notably, plan document failures, to the extent that you have issues with your plan document, those are not eligible for self-correction and would need to be addressed under the voluntary correction program. The voluntary correction program is more formal. It involves a specific filing with the IRS, and it does involve some compliance fees in conjunction with the process. But unlike the self-correction program, under the voluntary correction program, you do get a formal opinion from the IRS to make sure that they're pleased with the way that you've corrected the error. So just a note there. I mean, those can be complicated in making the assessments, but there are some good resources available in terms of correcting plan errors when they occur.
Okay. In true amalgamation format here, I think we probably have more content than we're going to have time for today. So I'll shorten what we were planning to talk about for the remainder of the time here. I know that we have lots of folks in the room today who work for nonprofits, and then expect that we have many who serve on nonprofit boards. We wanted to provide some reminders about the role of the nonprofit board, with particular tie back to our theme of operating in the current economic conditions and business climate. So amidst the pandemic, we saw a wide array of impacts to the nonprofit world. Some were particularly hard hit by declines in revenue, while others received large government funding or private donations to address the critical needs as a result of the pandemic, and were tasked with monumental responsibilities in caring for our communities. So virtually all nonprofits that we are associated with are faced with constantly adapting to a changing world, just as all businesses are. So we wanted to provide this list as far as fiduciary responsibilities as a reminder of what board responsibilities are in participating in the oversight of a nonprofit organization. We're happy to always talk more about that and any of the specific needs that nonprofit organizations that you're involved with might have at that level. One item we wanted to go over here too is the level of service that nonprofits need. This can vary by state, but in the state of Pennsylvania, if contributions are between $100,000 and $250,000, that will require a compilation to be filed as well, along with the registration. A level of 250 to 750,000 will require a review, and above $750,000 would be an audit. Just within Pittsburgh, it's estimated that there are over 18,000 nonprofit organizations, and those range in size from very grassroots organizations with many volunteers, all the way up to the large institutions that are part of our community. And then really rounding out the amalgamation, we have final slides here relative to document retention. We really don't have to spend a lot of time on this, but we do get questions about what suggested document retention guidelines would be. This is going to vary from organization to organization as to what fits best for you from maintaining your documents from a storage capacity standpoint and what fits for the needs of your organization. But it's suggested guidelines, and if you'd like to take a review to do a checkup on what you have in place, or if you need to sort of true this up, we've provided that information. So that really brings us to the end of our presentation. We thank you so much for listening about the common issues that we encounter in our conversations with all of you. Of course, if you heard anything today that you want more information on, be sure to reach out to Mark or myself or any of your GYF representatives.